Hi, my name is Harrison Schiffbauer, and I am a licensed mortgage loan originator, or loan officer for short. And today I want to talk about the four major loan programs, including their pros and cons. The first one I want to talk about is the conventional loan. While I don't have the statistics in front of me, most homeowners have a conventional loan. Now, the conventional home loan is for borrowers who have a bit of a higher credit score and have shown in the past that they can pay their bills on time. Now, if you have a credit score of 680 or higher, you can get yourself a conventional loan. Personally, I call this the sweet spot when it comes to pricing. For example, if you have a 620 credit score, you can still get a conventional loan. It's just going to be a higher interest rate and it's going to cost you more. Whereas if you have a 680 or even higher, you're going to be in the sweet spot and get better rates for better cost. Now, some of the pros for this program is that there's no mortgage insurance after an 80% loan to value, meaning if your home is worth about 400,000, at about 300,000, you don't have to pay that insurance anymore. Conversely, if you have a loan that's above that 80% loan to value, you're going to have to pay that mortgage insurance. But this mortgage insurance is actually cheaper than other programs because it's based off of your credit score. The next loan program I want to talk about is the FHA loan, or the Federal Housing Administration. This is a government-backed loan. Now, this is a great loan when it comes to borrowers who have a lower credit score or a little bit less of an income. For example, you can actually buy a home with a credit score as low as 580. The down payment on this program is 3.5%. This means more money in your pocket kept for your bills. We're not going house poor here. But let's say you don't have that 3.5%. You've still got options. There are programs available that allow you to finance 100% of that loan. It just means that you're going to have a second mortgage and a second bill. By the way, because it's a government-backed loan, you get the lower interest rates because banks feel so much better lending you money. Now, some of the drawbacks. This loan does have mortgage insurance for the life of the loan. But here's some good news. You can eventually refinance from this FHA loan to a conventional and get rid of your mortgage insurance. So ultimately, this is a good loan program that may cost a little bit more in the beginning, but if you go ahead and you follow those steps and get to the conventional, this is going to save you money and help you get into the home. The next loan program I want to talk about is the VA home loan. This is for the members of the armed services and the veterans. This loan program is arguably the best home loan program on the market, hands down. This loan requires zero down, allowing you to finance the entire loan. And get this, you get the lowest interest rates on the market through a super easy loan program. Now, the VA has made this super easy for you to get the lowest interest rates through what's called the Interest Rate Reduction Refinance Loan Program, or the EARL program as we call it. What this allows you to do is it allows you to drop your interest rate, save money on your home with minimal documentation. You know that income that you had? Don't have to show it. You don't need to get an appraisal, and you don't need to show assets. As long as you have met the VA requirements, which your loan officer should know, you will be in good hands. And by the way, I know these really well. So let's just say I'm your loan officer. In addition, the VA's cash out program is amazing. It allows you to take 100% of your home's value out, while all other loans are generally about 80%. Now, some of the drawbacks, aside from the fact that it's only available to active service members or veterans, is the VA funding fee. If you don't have a disability rating of at least 10% or more, you're going to have to pay the VA funding fee. In the case of the interest rate reduction program, or the EARL, this is a 0.5% that later this year of 2022 is actually getting raised to a 0.85%. On top of that, anytime that you cash out, purchase a home, or use your benefits in the capacity to take money out, you're going to have to pay a 3.6% on your loan. This is massive. Now, make sure you understand this before you get blindsided, because I can't tell you how many people I help, and they are not aware of how much that fee can cost. Now, the requirements that I was talking about for that oral program are as follows. You need to make 6 consecutive payments, wait 210 days from your first payment date, you have to drop at least 0.5%, and we have what's called recoup. It's this awesome mathematical equation that the VA has. What recoup is where they take your cost. You know what? We're talking about a lot of numbers here. Just call me. I'll go over it with you. Finally, let's talk about the USDA loan. You've probably never heard of this loan, but that's probably because of its guidelines. The loan is extremely similar to the VA's loan, except there are things that we have to abide by, such as where the home is. An example for this is there are specific rural areas that the department has determined is eligible for the USDA, but the house across the street is not. So, yeah, it gets a little funky, which is why it's not so common. But hey, that's why you've got me and your realtor, and we'll take care of you. So, the first pro, 0 down, much like the VA loan. But the con, it's only in specific areas, and good luck figuring out where those are. And by the way, there's one more con you really need to know about. USDA loans don't base your income off of yours alone. Any working member of the house has to provide their pay stubs in order for you to qualify for the loan. If you make too much money, you don't qualify. So, grandma who's living with you, her social security she's getting may disqualify you. But don't just throw this one by the wayside. Come talk to me. Let's look at your situation. It actually might be the best one for you. There you go. There's a high-level explanation of all 4 loan programs. And as always, if you have any questions, shoot me an email. Otherwise, we'll talk to you next time.